What is a wealth tax? A wealth tax is a tax on a person's assets, on his or her net worth. Technically, it is not a tax on income, but rather on an individual's wealth. However, people often use it when referring to income. Targeting wealthy people for taxation is especially popular among politicians. Advocates of a wealth tax system argue that it helps reduce inequality. Inequality refers to the wealth, academic, health, and housing gap. Inequality has been growing since the turn of the century. The richest 10% of the USA, for example, own a much greater proportion of the country's total wealth today than 20 years ago. Critics argue that a wealth tax is not effective. In fact, it can even result in lower tax revenue for the government. France, for example, introduced a wealth tax in 1998. From 1998 to 2006, France's wealth tax brought in very little revenue for the government. It also triggered a massive flight of capital. In other words, money left the country. In the 1970s, the UK had what's known as a super tax, which exceeded 80%. Many rich people, including Mick Jagger, David Bowie, and Michael Caine, became tax exiles. In 1979, the government slashed the super tax rate. Within a few years, most of the tax exiles had returned. In the 1980s, the government's super tax revenue was much greater than it was in the 1970s. Rather than introduce new wealth taxes, lawmakers should perhaps focus on getting rid of loopholes. Rich companies and individuals pay less tax than we think they should because they have excellent accountants. The tax system is full of loopholes. Accountants use those loopholes to lower their clients' tax bills. Thank you for watching this brief market business news video on wealth tax.